forecasted GDP, which was originally out at 2.8% up for the second quarter of 2024, to be revised down at the revision. So I'm usually right about that sort of thing, and it does surprise me actually that it instead was revised upward to 3%. But similarly to what I thought analyzing the first 2.8% number was that if you dig into what basically constitutes that now 3% increase, a lot of it has to do with consumers and consumer debt. Why those two things? Because the consumer in the United States continues to buy things. However, the amount of products, of services that are being purchased on debt continues to increase. The debt payments that face the American consumer continue to increase. And that's just not credit cards, that's household debt, that's auto loans, that's credit card debt, basically across all debt categories as per the latest New York Fed report on household debt. And what that means is that the consumer is stretching their budget through credit cards as opposed to through savings. And in fact, savings numbers have gone down this quarter, which is another indicator of that phenomenon. So it does mean that our growth really is constituted by debt. Our national growth, of course, is as well. We have over $35 trillion of debt as a nation, about 120% debt to GDP figure. And if you basically adjust the 3% up GDP figure by inflation, it's effectively flat still. So that's one of the reasons why, if we look at what the numbers are saying at the surface versus digging into them and getting into the feeling and the actualities of what's facing the American population on the ground, they're very different. It's why the American citizen feels pinched, even though we're looking at GDP numbers, which for America actually look quite good. But again, you adjust for all these factors and they're really struggling. The consumer wages have increased. Inflation has increased with that, and wages in some areas are higher than inflation if you look at it as an average. If you look at it on a regional basis, on a rural basis, on a manufacturing belt basis, there are a lot of pockets of America where that's not the case. And so the average kind of smooths out what a lot of the population is really feeling. And even in some of the urban areas where people are multi-juggling jobs and where they don't necessarily benefits for those jobs. And so they've got higher out-of-pocket medical expenses or childcare expenses and so forth. So if we look at wages in themselves, they're outpacing inflation, but we're also looking at, again, increased debt to bolster spending and increased payments to service that debt. And that does create a tension in the economy and for people. Apparently, sausages are rising in price, and that's an indication of a weakening economy because it is cheaper to buy pork-based products than beef-based products. So if we see an increase in demand for those products, along the lines of hot dogs, that actually means that people are replacing certain items with other items because, sort of ounce for ounce or pound per pound, they're cheaper, which drives up their prices and increases the inflation of those items. So the economics are really interesting depending on how you look at it. But from the standpoint of the consumer in general, there are more food items being placed on credit cards, more utility bills and portions of utility bills are being placed on credit cards. Even rent, where it's possible, is more being placed on credit cards. So even though, again, from the outside, these payments are happening and it's adding to, the external economics and GDP of the country on a digging into a basis on essentials versus non-essentials, people are putting more of their essentials and their non-essentials on credit cards. Delinquencies are rising at a pace as fast as they had been rising into the financial crisis year. So on par with the 2006-2007 year that ultimately was a contributor, not just with credit cards, but defaults and delinquencies in general for credit. Of course, that was a big subprime problem, but into the financial crisis. So there's stretching going on. What's also been interesting is that credit card companies seeing this, and this has been a trend I've started to watch more closely, they're starting to give more offers to people with better credit ratings. Now, they always do that. They always want to kind of balance lending to people who have to pay more for their credit card debt because they're less, sort of worthy credit card users in terms of their payments and their credit scores and so forth. But balancing that out with an increase in offers to people who can pay is really a way that we're seeing these credit card companies look at their full picture and say we could have some problems on the one end. We really need to top that off with the higher creditworthy consumers on the other end. And so they are sending out offers really again at a rate of 2006, 2007 to higher quality borrowers as well as personal loans. And to me, looking at banks for so many decades and looking at, credit for so many decades, it's a sign that they're looking for that marginal benefit in case something goes wronger with delinquencies or defaults or overstretching of sort of the average consumer. First, they did have an adjustment, an annualized adjustment of 818,000 jobs that weren't there that they had said would be there. And that's one large adjustment, and perhaps larger than Powell might have wanted to see. But also the increase is worrying because on the surface, we're saying that there's, the labor market had been hot according to Powell 6 months ago. He used the term hot labor market many, many times this year already. And he kind of stopped in the last two press conferences, but not entirely. And it really isn't until the latest one and what had happened at Jackson Hole in terms of him saying now is the time for a rate cut effectively in September that he has been looking nervous. And this is something that has been in the cards for a while. He has not, and the Fed has not really been paying attention to labor as much as they've been paying attention to controlling inflation. Of course, this is supposed to be their dual mandate to control price stability or inflation and also the employment picture to get, quote, full employment. We've not been at full employment this entire time, but this is something that he's been focused on both verbally, but perhaps not looking at what he's now talking about as dual risks. He wasn't using the term risk on labor until within this last month. And so this is, I think, why he's looking more and more nervous, because when you start to verbalize the word risk, and it's coming from his mouth and he thinks he might have missed something or the Fed might have missed something, that's where I think that nervousness starts to come in. Inflation, he sort of has a way of talking about. The labor market's quite something else. And 4.3% isn't awful, but it's 2017 levels. It's, if you forget the sort of COVID, really abnormal, as we all can agree, bump up in unemployment because people weren't like officially at their jobs. And it was a significant increase for a short period. But if we look at the trend, sort of taking that out of unemployment, we're back to levels 6-7 years ago. And so that is worrying. And the fact that every month we've been ticking up by 0.1%, that's a worry as well. If we start to get to 4.5%, I think he worries more. And if we start to get to 5%, I think he worries more. I think between now and the end of the year, we could see that 4.5% number. I don't think we get to 5%, but I think that's their concern. I don't think a rate cut at 25 basis points in September is going to fundamentally change the employment picture at all. It's that signal and that potential to add to that, say, over the next two FOMC meetings and indicate paying more attention to the labor market. One of the things that's also happened with employment is that we have been in a period where people are actually hiring, and as we know now, they're not hiring to the same extent. And when hiring is happening, it's very sector specific. It's government sector jobs as well. And we're also getting into the last quarter of the year. And generally, particularly we're in an election year, you're moving towards the end of the year. That's not really when companies bulk up on their payroll. It's really when they potentially look to trim things, whether they're doing well or not. And so, again, that's one of the reasons I see the unemployment potentially ticking up the rate no matter what happens with interest rates. And I do think, and I wrote this in a piece, that the Fed is a little bit behind the curve right now with respect to the labor market. What they're going to do with rates aren't necessarily going to change that dramatically, this year. It's been 5.25% to 5.5% now for a year, obviously up from zero in March 2022. It's had quite a steep ascent, probably somewhere on the average in there, 3.5% to 4% or something basically commensurate with where inflation sort of is, would be appropriate with respect to the labor market and this period of time. I don't see that happening again this year, but I think we could get to a 4% if the economy does slow down more dramatically, if inflation does and the Fed can pivot. But I think that's going to take a good 18 months. I've been of the opinion this entire cycle that if the Fed had done nothing, or if the Fed had done what it did and we can't really create two parallel universes, inflation would pretty much be where it is now anyway. And the reason I say that is because, there's two forms of inflation. There's the one that the Fed has absolutely no control over, and that has to do with supply chains, commodity cycles, geopolitical events, transportation disruptions, the climate situations that happen in agricultural locations and so forth. So there's so many things that impact inflation once there's a kind of catalyst of any kind. In this scenario, we had a couple of main catalysts happen within a short period of each other. We had COVID, which was obviously massive disruption everywhere, disruption to energy, to commodities, to transportation of them, to services, to mining, stopping and then starting. And we still have a little bit of residue from that. And that was compounded by the escalation of the Russia-Ukraine war and other geopolitical tensions like what's happening in the Middle East, et cetera, around the world. So you have a bunch of external factors that were related to these catalysts that have been playing out. And now we're at a situation where some of that has normalized, where mines have, for example, come back online, where transportation routes have shifted to an extent, where there have been solutions that have sort of gone over what has happened with geopolitical tensions, although, of course, that always remains a risk to inflation and to disruption of supply chains. There have been a reconsideration of supply chains by the United States with a lot of new legislation related to domestic supply, as other countries have done around the world, and securing supply around the world. And all of that has been a part of tempering what we see as inflation. Now, what the Fed can control, or central banks can control, is monetary inflation. They can control, to an extent, how much money is flowing in an economy. If you look at inflation in just those terms, they can have an impact. But if we look at inflation in real terms, in real asset terms, I don't think the Fed really had much to do with any of where we're at right now. And I don't think also, for example, if you look at the stock market as just a separate indicator of the ineffectiveness of tightening policy on financial asset prices, for the most part, you step back from the chart of the S&P 500, the NASDAQ, the Dow, you see a pretty much trend line up. Lots of volatility, lots of angst over what the Fed's going to do and when, and events that happen and how they play out. But for the most part, Fed's been raising rates, then stopping. Now it'll go to cutting. But before that happens, the market's been chumming along. So even monetary policy related inflation hasn't been subdued with respect to speculation of financial assets and markets. So this is a long-winded way of saying, I've been saying this for years, is that what the Fed or central banks do with rates, despite how much we talk about them and pay attention to them, don't necessarily have an impact for good or for bad on real asset prices, and therefore on many aspects of inflation.